Hey, what's up everyone? Today we'll dive into a company that's got investors sweating. You bet it right. NIO, the Chinese CV maker and promises luxury, innovation, and a Tesla cuter, is now slashing prices like it's Black Friday every day. What's going on with it? Is this a genuine move, or are we watching a slow-motion train wreck? So Golden Week's Label Festival just wrapped up in China, and NIO went hard on the discounts. We're taking 52,000 RMB, it's nearly around 7,000 USD off almost every model except the new ET9. Plus, their new brand, Envo, is throwing in free fridges. Yes, you heard me right. In-car refrigerators, free driver assistance for the 5 years, and even free battery swapping credits. And the new Firefly model, 10 years of free driver assistance. Now, on the surface, this seems like a win. More sales rate? Pump these numbers. But here's the problem, and it's a big one: brand perception. NIO was supposed to be a premium brand, as we know, right? And they were competing with the likes of BMW and Mazdas. Now they're acting like they're competing with whoever throws in the most free stuff. The article I read from China highlights a critical concern: customer trust. Existing new owners are supporting the company, but are they doing it out of loyalty or out of fear that NIO might go bankrupt? That's a tough question, and potential new buyers, they're going to be very hesitant to drop serious cash on a car from a company that might not be around in a few years. Look, my friend, price card can be a necessary evil, especially in a competitive market. But when you are talking about a brand that built its reputation on luxury and innovation, massive discounts scream desperation. It erodes brand value, pisses off early adopters who paid full price, and creates a perception of instability. What's the play here? Is NIO trying to buy market share at any cost? Are they hoping to flood the market with cars, hoping that volume will offset the lower margins? Maybe. I'm Sheila Wang. I'm here to update it on the most cutting-edge and fresh business and investment information for you. So don't forget to smash the like button and subscribe my channel. I also welcome you to join the discussion in the comment section below. Today, I've got a bold prediction for you. A prediction that is also, I think, totally reasonable. So don't go away, listen to my analysis and see if you think it makes sense. We're talking about NIO and whether they're closer to their end game than we might think. Now, for most car companies, you see them quietly, right? Without any warning, suddenly launching a massive promotion. That's a real sign that they're in a life or death situation. You know, like company X and company Y. But you know what I mean? NIO, we hope honestly, not yet, right? Let's be real. Li Bin, the new CEO, has some serious fundraising skills. Plus, they also have that unique battery swapping technology, charge and upgrade technology, of course. And NIO always have some kind of buzz going on. Plus, you've got sovereign wealth funds, state-owned enterprises, and CATL, the battery giants, all involved. Battery swapping went from being questioned to being accepted to now being a strategic advantage that can't be ignored. So yeah, they can still kick and scream for a while. But why do I think NIO's endgame is closer than we think? Here are a few key points. The solid-state battery game changer. When truly affordable solid-state batteries are mass-produced and available, and when truly high-power, continuous fast charging technology is actually here, and when other manufacturers agree to free maintenance and replacement of batteries after they degrade, then the battery swapping, NIO's biggest asset, becomes a huge burden. It's too big to feel, but it's also holding them back. The point 2, internal chaos. If there's clear infighting and disagreement among news leadership, especially regarding their strategic direction and business development, that's a critical moment for any company. It's a life or death situation. The point 3, financial red flags. Because NIO has a full cycle layout, as we know, from energy to production lines. If their financials are 2 to 3 times slower than traditional car company, especially if their payment cycle to suppliers is 3 times longer than Euro, then you need to be very careful about investing in their stock or buying their products. Look, NIO has a lot going for it. But these are some serious warning signs. If these 3 things happen, it could be game over. So what's the takeaway? Keep a close eye on NIO and do your own research before you invest. What do you think? Is NIO on the verge of collapse, or can they overcome these challenges? Let me know in the comment section below, and don't forget to give me a thumb up and subscribe my channel. Thanks for watching today. See you next time, my friend.